Hi everyone, this is Chris Smith from theoptionclub.com. This is a follow-up video to one I did recently on the XLF, which is the Financial Holders ETF fund. What you're looking at right now is a risk graph of the original position that I put on back in early August. And the basic trade was a diagonal spread that I put on for a credit. I had bought a January 15 put and I had sold a September $19 strike put, and basically I had $4 of risk, which is the difference between the $15 and $19 strike price less the credit that I brought in. And the theory behind the trade was that the XLF had sold off and found support around $20 per share, and that I was willing to buy the stock at $19 per share, but I wanted that extra protection of the long put in case that happened. Well, as time went on, the stock price moved, which is always the case. And that's one of the key things to understand about option strategies, is that we put these things on, and after we put them on, the market does something. And maybe it acts as we expect it to act, maybe it acts in some other way. But once it moves, there are opportunities to modify or adjust our position, and that's what I've done with the XLF. Okay, so it's now August 22nd, so it's been a while since we put on this trade, and we're seeing a modest profit from the spread. We've pulled back to the $20 strike, and we've bounced off of it, so it continues to hold as support. My expectation is that we will see the XLF continue to hold support at 20 and possibly trade higher. Now, the problem with the current position is that even though we have an unlimited upside profit potential, the upside profit potential is not significant. If you look at the graph, we're basically looking at something that gives us, a few dollars of profit as the stock moves higher. Nothing to really get excited about. The real action would be back here around the $19 strike. So if we're expecting the XLF to trade higher or possibly trade higher, it would be nice to open up the upper end of that risk curve. Now, the trade that I decided to do was I decided I was going to sell the September $22 call options, but instead of doing 3, which is what I did on the put side, I'm just going to do 2, and then we're going to move up to January, and we're just going to go 1 strike higher to the January 23, and we're going to buy 2 of those. So we're basically doing a call diagonal, and we're going to take a look at that risk curve, and we'll compare it to the prior risk curve and then the new risk curve. So what we've done is we've created a larger profit envelope, but we now have the potential of, if we really see a big move to the upside in the XLF, we could see a loss. Now, the reality is that's not what we're expecting. We expect that the XLF is going to remain range bound, at least for the next month or so. And we want to put a little bit more juice into this trade. So there's our new trade. We're now looking at a little bit healthier returns within the anticipated range of the XLF, and we've got a little bit different trade now. So we'll continue to hold that position and see how it looks as things unfold. Okay, folks, we're now looking at data from the close of market on Friday, August 29th, and this is our existing position, as it appears on the risk graph. what you'll notice is that the market's now moved higher. Now, we're still profitable on the trade. We could close the trade right now, take our profit, and be done with it. But we didn't come here to make 4 or 5% on this trade, even though a 4 or 5% return in a less than a month is a very legitimate return. But let's work with this a little bit more and see if we can pull more money out of it, over the next couple of weeks. So what I'm looking at doing is adjusting this position to accommodate what might be a further move to the upside. Do I think the XLF is going to really take off? No, but it might move higher, and I want to give the trade some room for the next couple of weeks to do exactly that. Now remember, August 29th, that was the last trading day of August. So next week, it's going to be a short week because we have the Labor Day weekend. So Monday there's no trading. So we got 4-day week next week. That's going to be our first Friday, and we're probably going to want to take the trade off the next Friday, or at least those front month September options. So we're only going to be in this exact position for another week to 2 weeks tops. So what I've done is I've added a double calendar, and I'm not going to take you through all of the analysis I did, but what I want to show you is how, with just the addition of a small position, we can shift that risk curve. So here comes the adjustment. And what we did is we just pushed that risk curve a little bit wider, and so we're now going to try to go for a 7%, a 10% return on our risk during this 2-week period, and we should be able to do here we should be able to pull out 7% without too much trouble. We might even get 10, 11% return. This line here, the line I just highlighted, that's just showing us basically not next week but the following week. It's about 11 days out, and we could do very well around 7% mark and get a good chunk of profit out of this adjusted trade. And we're going to keep watching this thing, and if we have to adjust it again, we can. Nothing's written in stone here. But the idea is we just want to keep this thing alive and let theta do its work, and keep our profit margin, this risk curve in an area where we are making money and not losing money. And that's the whole key. Is we're not so much focused on the making money side of it, we're more focused on the not losing money side of it. So as long as I keep that risk curve positioned so that I'm not losing money, the default is that you're probably going to be making money, and that's really where the game is won and lost. So one last time, here's the before picture. If you like the before picture and you want to keep it, you can do that. But here's the after picture. We've perked things up a little bit. So again, before, after. I like the after picture a little bit better. I think it gives us a little bit more opportunity and a little bit more safety, and that's probably where I'm going to go with this trade. So I hope this has been of benefit. Please do stop by our website, theoptionclub.com, and please do join us on our message board. Take care. Bye.